Good afternoon. I'm Robert Promisel, one of the global portfolio managers at Resolution Capital. I'm really pleased to be joined by Tom Herzog, who's the chief executive of Healthpeak Properties. Healthpeak is a large, diversified healthcare REIT in the U.S. It's headquartered in Denver, roughly $25 billion in asset value. Tom, good morning to you. Thanks for doing this.
Hey, Rob. Good to see you.
I'm wondering if you could talk a little bit about your company, explain the different business lines you're in, and then we can talk a bit about how you got there structure-wise.
Yeah. So as you started, we're about $25 billion in enterprise value. We're spread across three businesses at the current date. Life science, which is 50% of our NOI, medical office, which is 40%, and then we have a small CCRC business, which represents about 10% of our business. Each of these businesses are in high barrier to entry portfolios and literally impossible to replicate in today's environment, which is part of what drew us to those three businesses, and they'll all benefit from the baby boomer population. Another part of the business I probably should mention is our balance sheet, is at BBB plus, Baa1. That's something that we work toward over several years, and we do maintain a large life science and MOB development platform.
That's great. So I want to peer into life science a bit. It's a really interesting asset class that's been in the press in the past couple of years. You talk about your decision to really increase your exposure to life science and what you see for that business going forward.
As I look at Healthpeak over the last, we'll call it half dozen years, if you roll back in time, we were a REIT, a healthcare REIT that was involved in just about anything that touched healthcare. And we ended up just having a complete repositioning of our portfolio. We're out of a $30 billion portfolio at the time. We sold off or spun $18 billion of assets. Of the three businesses that we decided to retain, because we thought we had competitive advantage and they fit our business model, life science was one of those three. So that's how we got to giving so much more emphasis to life science than we did in years past. As far as what we like about it, life science is literally a burgeoning business, especially in the big three markets. But biotech just in general has been growing at a very, very rapid pace. If you look at drug development, for instance, and I mean in biotech, so live organism, large molecule drugs, it has literally tripled in the last, call it 10 years or so. The funding that is being provided to biotech companies has tripled. The amount of space that is in place in the big three markets of San Francisco, San Diego, and Boston has doubled. And at the current date, despite all that new supply, we're in a position where the occupancies are in the mid to even high 90s. So the business just continues to grow.
Right, and you've seen pretty strong rent growth there as well.
Yeah, when I look back at the last decade, or call it 12 years, I think is the last time I measured it, we have a CAGR of about 6% over a dozen years in the three big markets as far as rent growth.
Right. Before we go ahead with life science, I think maybe it's worth going back and talking about some of those sales. My understanding is that you had about a third of the portfolio was in senior housing just a few years ago, and that you sold off over $7 billion worth of senior housing, including over half of that during the pandemic, which is just a remarkable shift in your asset base. Maybe you could talk a bit about the decision to redeploy the capital away from senior housing.
Yeah, that was a big decision because senior housing, rental senior housing in particular, comes at a higher cap rate with higher risk and a lot of new supply and whatnot. So we had looked at that business, and first, we didn't think we had competitive edge with our portfolio, just the way that it had been built inside of our company over a decade and a half. We didn't feel we had competitive edge. We were nervous about a lot of new supply. The barriers to entry are very low in our view, and didn't feel it was a good play for Healthpeak. So prior to the pandemic, so over a few years, we downsized it pretty dramatically, reducing our operator exposure to certain operators and getting rid of a lot of our lower price point assets in especially some of the Midwest type markets where rents were low, CapEx was high on a relative basis. And we felt that was not going to be a good business for us going forward. So we had been reducing that. The hard part was making that final call to have an additional liquidation of senior housing that would be even more dilutive. And when the pandemic hit, as everybody knows, that was really hard on senior housing along with a lot of other sectors. And that caused the cap rates to drop or the yields to drop dramatically. And we were able to unload the final $4 billion. We have just a little bit left on a JV, but the final $4 billion of senior housing for the SHOP assets in the mid twos as far as cap rates. And if we went to pre-pandemic levels, it had been about a 6 cap. So we felt that was a very good exit point for us. So really, COVID ended up as a catalyst to allow us to do something that we wanted to do that had been very difficult otherwise. And then we took those proceeds and we delevered some, brought our balance sheet to just where we wanted it to be. And we reinvested those funds in life science and MOBs, more heavily in life science, but in those two businesses through either acquisition or development.
Right. So one of the quick summary conclusions would be not all senior housing is created the same. There's many different segments and they have different risk profiles. And the asset that you happen to own from previous managements were not necessarily the ones that would be the most competitive going forward. So you've taken that capital and redeployed it into a business segment, life science, where you believe you have a real competitive advantage.
Exactly.
So when I look at your life science portfolio, you're concentrated in the San Francisco Bay Area with a really good concentration in South San Francisco, concentrated in Southern California, really north of San Diego. And then in the past several years, you've developed quite a presence, a beachhead, if you will, a bit more than a beachhead, in fact, in the Boston, Cambridge market, really focusing on the alewife section of West Cambridge. Can you talk a little bit about the size of that life science portfolio and your development opportunity set that you have in front of you?
Yeah. So when we look at by the way, we're almost exclusively in the three big markets of San Francisco, San Diego, Boston. And we could get into reasons for that.
So a very narrow focus targeted.
Yeah, kind of narrow, but really the three big hotbed markets, which benefit on the supply side due to the huge barriers to entry as a result of constraints on land within those clusters that the biotech companies want to be. Yet on the demand side, there's just been huge growth, far higher than any other market. So the big three markets really do dominate for a variety of reasons. As we looked at why we wanted to really maintain our portfolio in those three big markets, it really came down to where are the research universities located? So in Boston, it's going to be like Harvard and MIT. And if you went to San Francisco, it's going to be Stanford and Berkeley and UCSF. And then down to San Diego, it's going to be UCSD and Scripps. And that's where the NIH funding comes in. That's where these genius professors come up with these new technologies and then spawn off biotech companies. And once that occurs, these scientists that have created these biotech companies, they need scientific talent. And it's across a whole variety of different types of scientists that provide the expertise required to do biotech drug development. And then the third thing is venture capital is absolutely critical. And venture capital will specialize in a particular market. And these VC professionals will sit on boards, they'll sit on management teams, and proximity is very important for where the VC will actually invest their money. And then finally, you have to have heavy land and lab infrastructure in place because these are specialized buildings. Lab buildings are very specialized buildings for the sensitive environment for things like ventilation and temperature and moisture and vibration and floor loads. So you have to have that critical mass again of these types of properties then to bring the biotech companies in so that they have a place to do business and develop drugs along with all that talent. So that's why we chose those three major markets, and that's what creates a cluster and an ecosystem that makes this whole thing work.
Right. So when you talk about specialized buildings, it sounds like you don't see these buildings every day, and they're not in every location. They must cost a bit more to construct, a bit harder to build, take longer. Maybe you could talk a little bit about just the know-how, what it takes to build a purpose-built, highly competitive life science building.
Yeah, I mean, when you think in terms of just the infrastructure required to house all these major systems that are inside of life science assets, the floor loads have to be much heavier built. The floor heights have to be much higher to house all of the ventilation systems and plumbing. The way that the building's built to handle seismic activity or just vibration, you've got HVAC and ventilation systems that run vertical and horizontal. There are just so many different things. It is very much a specialty product. So it's not like you just take your typical office asset where somebody wants to convert it to a lab building. Sometimes they'll work and sometimes they won't. We've had some that are successful, but usually when we look at them, that it does not, they don't pencil. Too expensive, and then they're not purpose-built, and therefore not as interesting to the life science tenant.
You can't really change the slab to slab on an office building.
No, you can't.
If it's not sufficient, it's not going to work.
Right.
And so in South San Francisco, where you also have Genentech as a major, it's not a university, but it's its own major anchor, if you will, of that market. You guys came in early several years ago and started developing, and now you have probably almost a 10-year runway of development opportunity there.
Yeah.
How much capital do you think you'll commit to that market? What type of returns do you think you'll achieve over time?
Well, what we have is we've got a sizable land bank and we have sizable densification opportunities in these three major markets, especially in South San Francisco and in Boston, especially in West Cambridge. But if we just added up the total number of square feet that we have available to us to develop right now, outside of our current 1.6 million square foot pipeline, we'd have another 6.7 million square feet that we have underway. So it 6.7 million square feet equates to somewhere in the vicinity of $10 billion of spend that we'll take on over the next decade plus. So we have a long runway. Some of that involves densification for assets that we have in, especially in South San Francisco, and some of it just involves the land bank. And then we just recently made an acquisition in Alewife that will result in a very significant project in West Cambridge / Alewife.
So nearly a doubling of your life science portfolio. You have existing land holdings that give you runway and visibility for doing that.
Right.
Yeah.
Right.
Yeah. That's terrific. Well, Tom, I just wanted to thank you for speaking with us today and giving us a nice overview and profile of Healthpeak, and particularly zeroing in on a real interesting business segment that you're in, that being the life science. Thank you very much.
Hey, Rob, one correction that I should make. I said 1.6 million square feet. I meant $1.6 billion of spend. Square footage is a little different than that.
Yeah.
So anyway, just to correct that.
Terrific. All right. Thanks again, Tom.
Okay. Thanks, Rob.
Cheers.